Morgan Stanley's Mike Wilson writing import cost exposure for S&P 500 industries is more limited thus far, given the combination of the countries in scope and the exemptions seemingly still in place. Mike joins us now for more. Mike, good morning.
Good morning, John.
Have we actually been tested? That's the question I've got for you, based on the note you put out over the weekend.
Well, yeah, I think we keep getting tested back and forth, and I think Anne-Marie did a brilliant job of kind of describing yesterday. It's just another example of the president controlling the narrative back and forth. You know, maybe the timelines now, I mean, he lets things go even shorter and then he comes back and reverses. And I totally agree. I think it's about trial balloons. It's no different than Fed policymakers. It's no different than other policymakers coming in and they trial balloon it to see how it will impact the market. So have we been tested? Yeah, we've been tested severely in the first 3 or 4 months of the year. We had a bear market. Stocks were down 35–40% over the prior year. So, I mean, we had a bear market. And so people now are looking for I go, well, you missed the bear market. We had it. You know, we bottomed in April. And all the indicators we look at from a rate of change standpoint have inflected sharply. That's what we wrote about in our mid-year update. And it's even surprised us to the upside. I mean, the earnings revision breadth is explosive. And so you just can't deny that. You can't deny the fact that companies are good at mitigating tariffs, for example. Import prices really aren't up that much. So the question is, who's eating these tariffs? That's the big question I hear now from clients. It's like, well, we're collecting all these tariffs, but where are they? Some of them are on the balance sheets of companies. It hasn't flowed through the cost of goods sold yet. Some of them are from exporters. They've discounted their pricing. They're eating the tariffs. And then some of it's going to get passed on to the consumer. That's to be determined still. And so as we've been saying, the third quarter is probably the quarter of risk where you'll see some of this flow through to the cost of goods sold. I don't think this is a massive correction. It's a 5–7% correction. For some companies, it could be bigger. But this is a quarter of risk for where the tariffs will start to hit. But the market's already thinking about this as a temporary impact. And 26 now on an earnings growth standpoint is looking better.
Is that a correction you'd be looking to buy then?
Absolutely. We're looking to, I'm hoping we get a pullback to some degree. I think a lot of clients are looking for a pullback of some kind. They've been surprised we haven't gotten one. But this is what the beginning of a new bull market looks like, right? It's just explosive. It doesn't let people in, right? The rate of change is accelerating beyond what you expected. So it's just, I think the pullbacks will be short and shallow. Maybe there'll be another surprise, another test of some kind that will cause something more severe. But I really can't see more than a 5 or 10% correction given what I see now in the landscape.